Hello and welcome back to the FX Evolution trading course. Today we'll be discussing how to correctly identify flags and pennants within the Forex and other trading markets. We'll also be looking at how to trade these as technical analyst traders. So what do flags actually look like in the market? Here we have an example of an upward trending flag and a downward trending flag. It's important to note that flags are breakout continuation patterns. So if we're trading a flag in an uptrend, we're looking for a break to a new high and for it to continue on. And in a downtrend, we're looking for a break to a new low and for it to continue on. A flag is formed when the high is broken, and we can see that there's a level of consolidation after that. This forms the flag area, and the breakout area, or the pole as we call it, is this area here. We can see in a downtrend, when the breakout happens, the pole is formed, and the series of consolidation after that is the flag area. So what's a pennant look like? A pennant in an uptrend is very similar. We've got a breakout, and then we've got a series of consolidation. The difference is how it consolidates. In a flag, it consolidates slowly over time, slowly going back down. A pennant, however, will be an actual compression of price. So you'll see that price is unable to move any higher or lower until eventually it forms this triangle pattern and breaks out hopefully to the high in an uptrend or to a low in a downtrend. So to summarize, flags and pennants form after a strong breakout. They also are continuation patterns. So how do we trade them? Here we have a flag trading strategy. So a flag in an uptrend, we've got the breakout zone, then we've got the series of consolidation forming our flag, and then we've got a breakout from the top of our flag and the market moving higher. So let's take a look at flags as a trading strategy. Here we have the breakout zone, which is forming our pole area. We've labeled this A. You can also see that after our flag consolidation area has formed and it's broken out to a new high, we've labeled this area as B. Because flags are a pattern, we can correctly identify take profit zones based on what we've previously seen in the market. The breakout distance, or A, will equal B. So if we were trading this, we would put our take profit or our close zone at the same distance as the previous breakout. This goes for both upward trending and downward trending markets. So let's take a look at pennant trading strategy. The same strategy can be used for both. Again, we have A over here, which is the breakout pole section, which equals B. So that means that whatever the distance is of the pole itself will be the distance that we're going to put the take profit. And this works in an upward trend and downward trending strategy. To further understand this though, I think it's best to look at a real example. So here we have the Australian Canadian dollar on a 4-hour chart in the MetaTrader platform. You can see that we've had a strong breakout of the zone and it's formed our flag pole. You can also see that there's been a series of consolidation after this forming our flag itself. When price breaks above, which is this candle here, and forms a new high, breaking our flag pattern, we can draw the distance of the previous breakout, or A, as B, looking for the take profit zone up here. You may not capture everything in the market, but if you use a technique like this, about 70% of the time, or even higher, you will be correct to your take profit zone. Because we're trading a pattern recognition technique, we know our take profit, but we also know where to put our stop loss. When it comes to flags and pennants, we place our stop loss below the last low. In this example, we can see here a low at this point. So if we placed our stop loss just below this low, we should be safe if the flag or pennant technique was to be successful. The great thing about trading flags and pennants is that we have very hard, fast techniques as traders to know what we need to do. So there's not too much decision making when it comes to take profits and stop loss areas. Let's take a look now at a flag and a downtrend example. Here we have the US dollar Japanese yen on a daily chart. You can see the breakout of the zone forming our pole. You can then see the consolidation area forming our flag. When it breaks out again to a new low, the distance that we can set our take profit at is the same distance as the previous pole. We can also see the market consolidated around this area for some time before making a new low. So we do know that generally when we take profit at these zones, it will be fairly accurate. So let's take a look at some rules of managing the trade. We can often predict the length of the flag and pennant trades because, of course, we know the pole length. The time to form the pole, or the time to reach the target, could be the exact same time that it's taken previously, and I like to allow 50% allowance. To put this in as an example, if it took 10 hours for the breakout to occur and then reach the new high, so 10 hours to form our A flagpole, it should take 10 hours plus 50%, so 15 hours for the next, or B flagpole to occur. This gives us very hard, fast rules when it comes to taking profit and also knowing how long it should take. And it's a very powerful tool when it comes to technical analysis trading. I also like to break even the trade, or at least reduce my risk on the trade, when 70% of the profit is reached. So this means that when 70% of the length of A happens on B, we should look to move your stop to at least break even. And this means that we don't have as much risk in the market and you'll be a lot more profitable overall. It's also important when managing the trade to monitor news and other similar market events. You can check out more in-depth technical analysis strategies in our advanced courses, but if you just follow these basic techniques, it should hopefully make you a more successful trader. That's it for today, and we'll see you in the next video.